Welcome to Smart Stock Watch. Today is 2026-02-18. We're covering Carvana's fourth quarter and full year 2025 results just released. With me is John, senior analyst at Smart Stock Watch. John, quick framing, what should viewers look for in this report?
Thanks. This is a big release. Carvana reported record revenue topping $20 billion for the full year, very strong retail unit growth, and a dramatic swing to profitability in 2025. Investors will be parsing revenue, unit economics like GPU, Adjusted EBITDA margins, and the items that drove one-time tax and warrant impacts on net income.
Revenue and profitability overview. Carvana posted Q4 revenue of $5.603 billion and full-year revenue of $20.322 billion, up 58% and 49% year-over-year, respectively. John, how significant is that top-line growth?
Very significant. Growing revenue near 50% at a scale above $20 billion is rare. It shows unit growth and higher throughput. The company sold 596,641 retail units in FY 2025, a 43% increase, which is the primary driver of revenue expansion. Importantly, gross profit also rose. FY gross profit was $4.192 billion, up 46%, so growth didn't come at the expense of gross profit expansion.
The company also reported net income of $1.895 billion for FY 2025 and a FY net income margin of 9.3%. What's behind that jump?
The net income gain is partly operational, improved unit economics and scale, but materially influenced by a one-time non-cash tax benefit, the release of a valuation allowance against deferred tax assets, and recording of the full tax receivable agreement liability, contributing roughly a $685 million tailwind. So the operational progress is real, but investors should separate one-time items from recurring profitability.
EPS forecast. We have consensus data. Analysts were forecasting EPS of $1.30 based on 8 analysts. The company reported diluted net earnings per Class A share of $4.22 for Q4. John, that's a very large beat. How should viewers interpret this gap?
It's a huge beat on face value, but we need to unpack it. The reported EPS includes the same non-cash tax receivable and valuation allowance benefit that boosted net income for the quarter and year. So while EPS materially outpaced the $1.13 consensus, a significant portion of the upside is timing one-off tax accounting and warrant fair value movements. The underlying operational EPS, if you strip those items and look at adjusted measures, still improved meaningfully, but not by 4 times the consensus.
So investors should be cautious in assuming the full $4.22 is recurring.
Exactly. Viewers should note the headline beat, but dig into the reconciliation and adjusted EPS, not explicitly reported here, to understand recurring profitability drivers versus one-off accounting items.
Operational efficiencies and unit economics. Carvana grew retail units sold 43% to 163,522 in Q4 and improved total GPU at the full year level. John, how are unit economics holding up as they scale?
Overall unit economics improved year over year. FY total GPU rose to $7,026 and adjusted EBITDA margin expanded to 11.0% for the full year. However, Q4 retail GPU dipped sequentially, driven by higher reconditioning costs in some locations, increased retail depreciation, and lower shipping fee revenue as cars were sourced closer to customers. Management also called out elevated reconditioning costs tied to lower tenure management at some production sites, which they expect to address as processes mature.
They also reported operational cost reductions per unit. How meaningful are those?
Meaningful. Operations expense per unit fell by $118 and overhead per unit by $355 year over year. Those efficiency gains are critical to reaching the company's long-term target margins as scale improves and advertising efficiency matures.
Customer experience and technology. The company highlighted AI-driven customer care and faster deliveries. How do these operational changes translate into competitive advantage?
They translate directly into conversion and lower costs. More than 30% of buyers and 60% of sellers now complete transactions without speaking to an advocate. That's both a customer experience and cost-saving win. Shorter delivery times, lower shipping fees, and fewer calls per sale improve unit economics and NPS. These improvements support sustained growth and help Carvana pass value back to customers, reinforcing word-of-mouth and acquisition efficiency.
Management framed these as durable improvements, not just one-offs. Reasonable?
Yes, these are structural. More inventory pools, 34 at year-end, denser logistics, and software-driven workflows like Carly and Heads Up should persistently improve throughput and lower per-unit costs over time.
Capacity expansion and growth outlook. Carvana is focused on ramping production capacity via ADESA partnerships and full build-outs. John, what's the path to their 3 million unit target, and what did management tell us about 2026?
They now have built capacity for roughly 1.5 million retail units and say they have the real estate to support 3 million. The plan is a mix of staffing, integrating more ADESA lines, selective full build-outs, estimated $30 to $35 each to unlock 40K units, and occasional greenfield sites. For 2026, they expect significant growth in retail units and Adjusted EBITDA, including sequential increases in Q1, assuming macro stability. Execution risk remains, but the structural plan and investment cadence are clear.
Balance sheet, liquidity, and risks. Let's talk balance sheet. Cash was $2.327 billion and total liquidity potential listed at $6.739 billion, but long-term debt remains substantial. Your take?
Liquidity has improved. Cash and available revolver capacity are meaningful, and the company lists sizable additional debt capacity under indentures. However, long-term debt of about $4.83 billion is not trivial. Carvana's ability to scale while managing working capital, vehicle inventory, finance receivables, and interest costs will be important. The company disclosed many forward-looking risks: macro demand shifts, industry pricing, and the need to scale reconditioning and production without quality lapses.
Any notable one-offs investors should be watching?
Yes, the tax receivable agreement and the release of valuation allowance generated a large non-cash income benefit, and warrant fair value changes added volatility. Those items can swing GAAP net income materially and should be separated from normalized operating performance when modeling future earnings.
Market reaction and sentiment. How do you read the market sentiment from this release, John?
The sentiment is broadly positive. Carvana delivered strong growth, record revenue, and moved firmly into profitability on a GAAP basis for FY 2025. However, the market will temper enthusiasm given the large one-time accounting benefits underpinning some of the net income and EPS strength. Investors will watch whether the company can sustain margin expansion through improved reconditioning execution, advertising efficiency, and ADESA integration without sacrificing customer experience.
Did the company provide any immediate corrective actions on the reconditioning cost issue?
Yes, management acknowledged higher than expected reconditioning costs in lower tenure locations and pointed to improving management workflows and Carly-driven process standardization to reduce these costs. They expect elevated reconditioning costs in Q1, but forecast sequential improvement in retail GPU thereafter as these fixes take hold.
Key takeaways. John, wrap this up for our viewers. How should investors think about Carvana from here?
Carvana is showing scale-driven improvements, strong unit growth, record revenue, improving Adjusted EBITDA margins, and positive GAAP net income in FY 2025. The long-term thesis, growing to multi-million unit run rate with expanding margins, remains intact. Near-term investors should focus on sustainable unit economics, reconditioning execution, and debt dynamics. If management executes on ADESA integrations and drives advertising efficiency, upside is meaningful. But there are execution and macro risks to monitor.
Thanks, John. And to our viewers, we'll keep tracking Carvana's conference call and post the full notes on Smart Stock Watch.
Thanks. Looking forward to the Q&A in the call to hear more granularity on Q1 expectations and reconditioning improvement time.